Well, hello and welcome, everyone. My name is Joel Schumacher, and I'm an associate specialist here with MSU Extension, located in the Department of Agricultural Economics and Economics. And I'm also an accredited financial counselor. Today, I'd like to talk to you a little bit about managing some non-ag related risks from the perspective of a farm and ranch family. So we'll talk a little bit about health, life, and disability insurance as some of the tools that we can utilize to help manage some of those risks to your operation. Farm families or ranch families are very familiar with managing risk in a variety of different settings. And some of the most common ones that we see are things like drought or hail, or maybe flooding, early or late frosts, or diseases in crops, pests, maybe predator losses. And then on the marketing side of things, we certainly don't always have a complete control over what prices will be, or even what basis will be at the time of marketing our crops. And then also on kind of the management side, you're choosing between how many acres of wheat or barley to produce in a given year, what variety, when to fertilize, when to spray, how to market those things, whether to invest in newer equipment or repair your current things, are all, you know, decisions you're making. And I'm going to generically lump all the things on this slide into kind of agriculture based risk. However, there's also other risks that can impact the long-term viability of your ag operation that are not necessarily agriculture related. So it could be an illness to maybe one of the primary operators, or an injury. Um, and the result of that could be some medical bills. It might mean you're unable to work for a period of time. Maybe it's just a few days or a few weeks. Maybe it's longer. And also a big risk could be, a premature death as well. That could put your operation at risk in terms of passing it on to maybe the next generation, or even to be able to continue currently until maybe the next generation is at the right age to take over that operation as well. So we're going to talk a little bit about some of the tools to manage those things that can put your operation at risk. So there's a number of different ways just generically that we can deal with risk. The first thing is to try to reduce or avoid risk. And, this comes down to all kinds of very simple things, whether it's safe behaviors like, using seat belts obviously lowers your likelihood you're going to get injured in an accident, different farm safety protocols, using equipment for the purpose it was designed for. And then also on the lifestyle side of things, things like not smoking, exercising, having an appropriate diet, all generally improve your health and therefore sort of reduce some risks that way as well. And then there's also some types of risk that we simply hire someone else to do to avoid that risk completely. So maybe you're having your house roofed and you don't think it's particularly safe with the equipment you have to walk around on your roof. So you might hire in roofers, and then your risk obviously of falling off of that roof is essentially zero if you're not the one going up there. So some things we do just transfer the risk by hiring it to someone else. But it's not possible to avoid all risks. So we also have to have tools to manage whatever that remaining risks are, and prepare for those things. And one thing is to have a lot of these risks have a financial component. So sometimes having access to some savings, some cash flow that we can get to, or a line of credit, is a way to prepare that we know, let's say, um, the pickup pulling the horse trailer gets into an accident. We know we have insurance to pay for a portion, but we know our deductible is $1,000, making sure we have access to the $1,000, so that event doesn't become a major event. So, and then transferring risk, which I already mentioned, is insurance. So we're essentially paying the insurance company to take on the risk that vehicle gets into an accident, or that I get cancer and have to have expensive treatments. So for medical risk management, obviously health insurance is the primary tool people utilize to transfer that risk to other people. Um, we'll talk a little bit more about that in a minute on insurance and the costs and how to kind of think about that in terms of a risk management structure. But then both Montana legislators and federal legislators have provided some tax incentives that you can save on health expenses not covered by health insurance. So I'll kind of briefly go over those as well. So first of all, I looked up the most recent data I could find here in the National Health Expenditures Survey for 2018. Says that on average in the U.S. we spend about $11,000 per person on medical expenses during a year, and that's all types of expenses, from hospital bills to prescription drugs, everything, the whole gamut, rehabilitation, all of those kind of things. And that is a big number. But what's particularly problematic with that number is it might be, somebody has $300 every year for 4 or 5 years, and then all of a sudden they have 400,000 or even 30,000 because of a single event that happens. So it's managing those really big years that can be very challenging. We've heard a lot about healthcare spending over the last 20 years. Healthcare from 2010 to 2018 grew at about 3.8% per year. GDP over that time period grew at 3.3%. So essentially, healthcare expenses are growing faster than the US economy was. So what that means is it's taking a larger and larger portion of sort of America's collective paycheck. Now, that is definitely a trend that is challenging. On the other side of things here, compared to the period of 2000 to 2010, healthcare expenditures were growing at almost twice as fast, 5.6% versus 2.9% GDP growth. So we've certainly narrowed the gap, both in terms of GDP growth increasing some, but also the rate of healthcare growth is not nearly as high as it was in the previous decade. So the trends are in the right direction for this problem. But still, we have this problem of it's taking a larger and larger chunk of our collective paycheck each year. So health insurance is a primary tool that a lot of Montanans utilize to manage this risk and protect the assets that they own. The number one place that individuals get their health insurance coverage is through their employer. And that's not just for the employee, but they may also cover their entire family with some plans as well. So about 445,000 Montanans get their insurance through their employer. It's about 41% of the population. Medicare, which is our a government based insurance program for those age 65 and over. So essentially, nearly everyone age 65 and over has that coverage. That's about 21% of the population, or 226,000. That's been rising in Montana simply due to the fact that our population over the age of 65 has been increasing as well. Medicaid, which was a program, it's a government healthcare system or provided care system that was really primarily designed for the lowest income Americans. And then as a result of the Affordable Care Act and then some choices state legislatures made based upon that, they expanded the eligibility to that that included some Americans that were making more than what would have made them eligible for Medicaid previously, but still are relatively modest income earners as well. So that number increased fairly significantly as some states chose to allow individuals in that higher bracket to join the Medicaid program. You probably heard a lot about healthcare.gov or the healthcare marketplace, sometimes called an exchange. And this was the individual marketplace where people could go to purchase private policies. It was part of the Affordable Care Act. In Montana, about 4% of Montanans are purchasing healthcare policies through that, or about 42,000. There are some individual plans that are also sold not through that exchange. There's about 10,000 of those. So only about 5% of Montanans are actually purchasing a policy individually just by either going through this exchange or going directly to an insurance company, maybe through an agent to do that. But again, a relatively small portion, even though they probably get an outsized amount of the news about healthcare is focused on this particular group of folks. And then our prison population, they kind of have their own healthcare coverage as well. And then in Montana, we still have about 92,000 folks that do not have an insurance product. Two other quick notes on this. Folks that receive services through Indian Healthcare, that is not formally an insurance program. The same would be true for some of the VA services. So there may be some Montanans that are in this uninsured group that do have access to some medical care, but it's not handled in the same way kind of as a traditional health insurance product. The uninsurance rate in Montana did fall fairly significantly from 2013 to 2016. A big part of that was the Medicaid expansion. Another component of that also was the aging population in Montana, so more Montanans are covered by Medicare as well. Now, several years ago, they added a few restrictions in terms of how the Medicaid expansion program in Montana is working. We have seen a slight increase in uninsured since that time period as well. So there's some other factors going on, but just to give you a little bit of history as to where we're at today. Now, if you're to go out and purchase a plan individually, which many farm and ranch families may not have access to a employer sponsored plan, they group them into four types of plans: bronze, silver, gold, and platinum, with platinum being kind of the best, but also the most expensive as well, and bronze being the least expensive, but also providing the least coverage. Um, Gold and silver, probably silver specifically, are the most common plans sold. Just to give you an idea of what some premiums could be, the Montana Commissioner of Securities and Insurance, which is also known as the name as the Montana State Auditor, um, that office is in charge of regulating health insurance in Montana. So this is where the information I'm showing you came from. They've got a bunch of other very good resources on their webpage as well. But to give you an idea here, for a silver plan with a $3,500 deductible and a $6,750 maximum out-of-pocket expenses, with a co-insurance contribution of 25% for someone living in Gallatin County. They've actually got them grouped by about 5 regions in Montana, so it's just the region that includes Gallatin County. A 30-year-old would pay $466 a month for that plan for 2020, where a 60-year-old would pay over $1,100 for that same plan. So your age obviously plays a big role. Now, about 87% of the plans purchased through the exchange, which again was about 4% of Montana policies, are going to receive some type of tax credit to offset the cost of that policy. Now, a bronze plan with it has a higher deductible, higher out-of-pocket maximum, and a higher co-insurance rate, but also for a Gallatin County resident. Here you can see the premiums are quite a bit lower, $256 a month for the 30-year-old, going up to $612 for the 60-year-old. So in this case, they would get less coverage from the insurance, but they would also pay less per month to get that policy. So there is some shopping to be done in terms of what level of coverage and what level of risk you want to transfer to the insurance company. I didn't put down a whole bunch of those, but these healthcare exchanges did create kind of an easy marketplace where you can see these prices in a relatively easy way. Healthcare.gov is that national exchange, is where they have all that information. A few states chose to create their own exchange. Montana, along with I think the majority of other states, utilize the single healthcare.gov platform that was created at the federal level. But again, there are subsidies for modest income Americans, so somewhere between 100 and 400% of the poverty letter. The Kaiser Family Foundation has a great calculator if you're wondering if you might be eligible for subsidies. I would definitely recommend going and utilizing their subsidy calculator to see where you fit in there as well. Medicaid expansion, the way the kind of whole system should work, Medicaid traditionally served very low income Americans. Medicaid expansion allowed it to serve kind of the next group up. The subsidies that are then provided through the Affordable Care Act is kind of for the next highest income level of Americans. So the three kind of work together in terms of that too. There were also some other changes with the Affordable Care Act, like allowing children to remain on their parents' health plan until the age of 26. Also some limitations on insurance companies denying treatments for conditions you had previous to having that policy. So there's a number of different components, but those are just a few of kind of the 30,000-foot highlights. I mentioned that states had the option to expand Medicaid under the Affordable Care Act, and there were some terms, but there were some choices the state needed to make. It was not mandatory that they do this, and then different states did adopt some slightly different rules within that broad framework provided by the federal government. In Montana, we call it the HELP Plan, was the act that allowed the expansion to take place, and it initially allowed for Medicaid enrollment after January 1st of 2016. We did choose to charge premiums, which not every state did. They're capped at a maximum, I think, of 2% of an individual's income. And again, these are relatively modest income earners, which meant the premiums averaged about $26 per month for these type of policies. Regardless of what type of health insurance you have, or if you have no health insurance, there's likely to be some additional out-of-pocket costs that you're going to have to pay for medical expenses. So whether that's a copay for a prescription drug, maybe it's you have health insurance but not dental insurance, so you have a fee there, or maybe there's a deductible of $3,500, so you're responsible for much of the first $3,000 or something of expenses. There are also some tools to help you reduce the cost associated with paying those type of medical expenses. One of these is what's called a flexible benefit plan. Now, this has to be offered through an employer. So if you are a farmer ranch family that does not have off-farm income, you may not have access to a flexible spending account. We'll go over some brief details of each of these here in a minute. Health savings accounts are also a tool that allows you to save on state and federal income taxes. And they're open to anyone that meets the eligibility. There are some fairly significant eligibility rules um, to be able to have one of those accounts. And then we have the Montana Medical Care Savings Account, which only helps you save on state income taxes, but it's open to all Montanans over the age of 18. So essentially, there are very, very few limitations on the Montana Medical Care Savings Account, but it does only save you on state income taxes and not on your federal as well. So for these flexible spending accounts, again, your employer has to offer them to you. The employee would sign up through a payroll deduction process, and the maximum that the federal government allows is $2,650 per year for medical expenses. It's possible your employer may say, although the federal government allows that, we may only allow 2,000 or 1,500 or something like that. That's kind of their choice, but that's the federal maximum there. And then one of two things can happen at the end of the year. Either $500 if you put in the so let's say $2,000, but you only had $1,800 worth of expenses. That 200 that's remaining could be rolled forward to the next year, so you don't lose the money. It just rolls forward 1 year, but 500 is the maximum that can be allowed to be done with that. Alternatively, employers can choose, instead of allowing you to carry it over, so in the example I gave, the $200 to the next year, they'll give you an extra 2.5 months at the end of the plan year to utilize for any medical expenses you might have during that period. So one or the other your employer can choose. The nice thing on these is it reduces your both federal and your state income taxes for contributions that you put into there. So if you think you're in a 25% federal bracket and a 6.9% state bracket, every $100 that you put into this account and then utilize for an eligible medical expense, that's going to save you about $31 instead of had you just written the check and not utilized a flexible spending account. All right, health savings accounts. This allows a person to save, again, for future medical expenses. The maximum here is $33,550 per year. If it's a family savings account, it can be $7,100. And these, you can actually continue to build up account balances over multiple years. So if you're, let's say, 40 years old and you start putting $3,000 a year in and you only have $1,000 of expenses, you may have 10, 15, 20,000 built up in this type of account that then you could utilize maybe when you get older or a year that you have a large expense. So some people use it as a long-term way to save for medical expenses. And as probably most of you know, medical expenses tend to go up as we age. So it's again a way kind of to save for some expenses down the road as well. To be eligible for one of these, though, you must have a qualifying high deductible health insurance plan. So this means that the deductibles are relatively high compared to most plans. In this case, the minimum deductible is $1,400 for an individual, and the out-of-pocket maximum can't be more than $6,900. If an insurance company is offering you one of these products, they will clearly label it to you as a high deductible health insurance plan. Now, where I work here at Montana State, we actually do not have an option for this type of plan. So, um, and many Americans will be in that boat where their health insurance coverage is not a qualifying high deductible plan, and therefore health savings accounts would not be available to them. This does save on both your federal and state income taxes. Again, so for every $100 we put in, it's not unusual to think that we might be saving $30 in taxes for using this for our medical expenses. Now, Montana medical care savings accounts are much simpler. You open it at whatever financial institution you like, bank, credit union. Some investment companies will also open them. Anyone over the age of 18, $4,000 maximum can be contributed in a year. You are allowed to build that up over multiple years. It does not expire at the end of the year, but this only saves you on state income taxes. Now, Montana, the top rate is 6.9%. You know, for every $100 then that you put into this, the most you could say would be $6.90 on those. So it's available there, and again, it can help you get a discount kind of on your medical expenses. The nice thing about Montana medical care savings accounts is just their eligibility is really to anyone. You don't have to have it offered by your employer. You don't have to have a particular kind of health insurance plan to do that. And all of these are generally using the same set of rules in terms of what eligible medical expenses are. Montana just defers to the list that the federal government, the IRS, has prepared. And there's, you can certainly Google that and find that list relatively easy. But things like copay, out-of-pocket expenses, they've went back and forth, but currently you can do over-the-counter medicines. So if you bought some cold medicine or some Tylenol or something along those lines, those are eligible as well. Dental costs, prescription glasses all count. And oftentimes even things like if you bought a wheelchair or a cane, medical equipment, hospital bills, rehabilitation, all of those type of things are generally eligible to be reimbursed. Now, let's shift gears and talk just a little bit about unexpected death. So certainly medical issues are one thing, but what if you or someone in your family dies unexpectedly, maybe much earlier than you had planned, and maybe they were a working member of your operation and part of what made that operation viable. You certainly hear about things like what the funeral costs are, and it's running about $9,000 for a traditional funeral. Cremation more like 5,000, but that's usually not the big expense. The big expense is typically the income replacement for your dependents. If you're middle-aged and you still have kids at home and maybe you have a spouse, if you're one of the main workers on your operation, would they now have to hire someone to get the same amount of work done? Which obviously would be an expense to them, right? It's missing that income that you would be bringing back to the family. Some people also want to utilize life insurance to make sure that their child can go through college, or maybe they also want to pay off the mortgage or some particular portion of debt. If I were to pass away, maybe I want to make sure that my house is completely paid off. So I'd like to make sure I have that much life insurance. Those are different reasons why people buy life insurance, but all of these are things that people commonly consider in their calculation for how much they need. When you're thinking about how much to buy, it's not necessarily a fixed number for everyone. How much income will your family need? What have you been spending recently, and how much of your income would go away if you were gone or some other member of your family was no longer able to work on the operation? Also, if you're, let's say, 30 years old and you're expecting to work for another 3 or 4 decades, you're replacing income if you were to pass away for your family, maybe for the next 30 or 40 years. However, if you're 60, maybe your family was only sort of expecting you to work for another 5 or 10 years, at which point you kind of have less income that you need to replace over the course of your career. And then, if you're single, maybe you don't have other people that depend on your earnings, and there's not a need to replace very much income after you're passing away. Quite different from maybe, someone who has several small children and a spouse that they're supporting as well. And then some families, there's only one income source coming in, and other families, there's more than one. So also kind of just understanding that dynamic may play into how much income you think you should provide for your family. Couple very quick examples. If we have a husband that earns 50,000 a year, obviously the take-home pay is not 50,000. We'll just call it 37,000 for our example. Partially being because you're not paying certain taxes, partially being because this husband's no longer contributing to their own retirement fund or their own health insurance. Those expenses will go away if that individual were to pass away. They've saved some money in their 401k. Wife is a part-time worker, earns $25,000 again, has a lower take-home pay, but has some money in her 401k. And these folks they're married, no kids, and they're age 55. If their goal is to have $10,000 available for funeral expenses and then replace 10 years of earnings, which again would take them to about age 65, and they just want to replace 80% of what they were previously taking home, you can certainly find a life insurance calculator on the internet. Pretty much every insurance company has one, and they're fine to utilize. In this case, the husband would need $139,000 worth of life insurance to meet their needs. He really needs 289,000. However, he has 150,000 available in his 401k account that his wife can now utilize, since it won't be for his retirement. So the amount they would kind of purchase would be 139. The wife would just need 120,000. Again, slightly higher number of 145 is what they would calculate, but then she can reduce that by that retirement savings that are available. Let's just change things and say they want to replace 20 years of earnings instead of 10, and you can see it jumps up the amounts the husband needs to 300,000 and the wife to 200,000. Again, because they're replacing 10 more years of earnings if that was their goal. So kind of some simple rules of thumb: the more years of income we're replacing, it's going to be more insurance that we need. The more savings that you've got on hand, whether it's 401k or things, may lower the amount of insurance that you need. And then the more one-time costs that you want to cover, like a college education, paying off a mortgage, paying for funeral expenses, those would increase the amount of insurance that you might need. Layering policies or laddering policies is a common strategy for term life insurance. So if we have a husband that wants $300,000 worth of coverage, he might buy a 10-year policy for 150,000, a 20-year policy for 100, and a 30-year policy for 50. This 10-year policy is going to be relatively inexpensive because his likelihood of dying by actuarial results before the age of 55 is pretty low. So it'll let him buy that coverage fairly cheaply. And then at the end of the 10 years, that 150,000 would expire. However, in that 10-year policy, if he did not pass away in that 10-year period, he wouldn't need to replace the income for that time frame. So his life insurance needs are likely to decline as he ages anyway. So this sort of naturally sets it up to let him get more coverage now at a relatively less expensive way, and then have his life insurance coverage decline when his needs for life insurance are also declining as well. So that's called laddering of policies. There are whole life insurance policies, and the premium stays the same and the coverage lasts for your whole life. Premiums tend to be a little higher for younger purchasers, and they can build cash value that sometimes you can borrow against as well. One challenge with whole life policies is just that your life insurance needs probably change as your life circumstances change, and a whole life plan does not modify nearly as easily as some of the other types of policies to meet your changing needs. Term life insurance is what I just mentioned. It's coverage for a fixed period of time, 10 years. If you don't pass away within that period, the policy expires. Your payments essentially just went to the insurance company and then weren't utilized in a sense, or you didn't get a benefit or your family didn't get a benefit that. But the premiums tend to be lower again because many of these policies expire without someone passing away. So usually the least expensive way to get coverage, um, but there's not a guarantee that your beneficiary will receive a payout during the time period of that policy. Disability is another thing to be concerned a little bit about. Might prevent you from working, might increase your medical cost. Social Security does have a disability component to it, but some people choose to purchase extra disability insurance as well. So just to kind of wrap things up, when thinking about risks from these non-ag related things, the kind of the three main steps is, first of all, what can you do to minimize and avoid risks? And go ahead and do that in the ways that are reasonable and accessible to you, but obviously understanding you're not going to be able to transfer all risks, so then you need to prepare for that. So that might be having some funds available, a plan for if you were unable to work for 4 weeks, how would things get done. And then there's probably a point where you need to transfer some of that risk to other people. You'd hate to have a successful operation that you've been building for maybe 20 years and you've built equity in, and then you run into some very significant medical expenses, um, or you become disabled and you all of your assets that you've built and maybe hope to pass on to your family might be wiped out in a relatively short period of time. So having an insurance company take some of that risk from you is oftentimes a good way for folks to protect the value that they've built into that operation. I know this was a bit of a summary today for some of these things, but hopefully it gave you a little bit of food for thought in terms of long-term operational success and trying to manage some of these risks that could, kind of threaten that long-term financial viability. I am happy to take questions or email questions as well if you do have some further questions or would like access to some resources related to some of these things. So I hope it was helpful today, and I look forward to answering any questions that you might have at a later time.